Meet Joe Investor. He's always on the wrong side of the market. Last year, Joe Investor was shorting stocks when he should have been long. And the year before that, he was parked in cash when he should have been invested in bonds. Are you always on the wrong side of the market just like Joe? The Profit Strategy newsletter at etfguide.com will help you to succeed. Join today and get a $100 gift by using promo code JOE100. Go to etfguide.com to get started and promise yourself to never ever be on the wrong side of the market.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Let the spending spree begin. Debt ceilings have done little to curb the U.S. government's escalating debt load. And if you thought overspending was a serious problem before, welcome to the next cycle. We'll talk about that on today's broadcast. Also coming up, China's busted bank loans hit 2008 crisis levels. Can you believe this? China is either on the verge of economic utopia or on the verge of a major economic shock. Depends on whom you believe, depends on whom you talk to. We're going to get through the data on today's show. Also coming up, my program guest will be Dan Dolan of the Select Sector SPDR ETFs. Now, we'll be talking the S&P 500 industry sectors. And of course, as most of our listeners know, the Sector SPDR ETFs divide the S&P 500 according to the 9 sectors within the S&P 500. So we're talking about healthcare stocks. We're talking about technology, financials, industrials, energy stocks, utilities, and you can just carve up the S&P 500 and own whatever portion you want to own. So we'll get into what is going on with some of the key sectors within the S&P 500. We'll also give you a rundown of what's happening in major markets performance-wise, from stocks to bonds to commodities. If you'd like to join us to talk about a particular stock, ETF, mutual fund, or investment theme, 877-711-5611. That is the number. Give us your first name along with your city. Again, 877-711-5611. You can also tweet the program live at Index Show is my Twitter handle. My email address, ron@indexshow.com. So Janet Yellen making her debut as Fed chairwoman this past week, and stocks celebrated her arrival. We saw the Dow Jones Industrial Average and the S&P 500 both ending the week up around 2.3%, and we see a nice rebound so far in stocks after a dismal start to the year. And, Jason, what's his last name? I can't think of his last name. He does the Sentiment Trader. And Gopfert, that's what it is, Jason Gopfert. And he does an excellent job of giving a rundown of what's going on sentiment-wise, technical-wise. And this is what he had to say about what's been going on with the S&P 500 and its rebound after a horrific, well, I don't want to say horrific start, but a rough start to 2014. This is what he had to say. He rates the current situation with the S&P 500 as very high risk. He rates it level 8 out of 10, and this is what he had to say, quote, "The rally over the past 3 days has been unusually high in that we were already stretched according to several of our short-term guides, yet stocks have continued to climb. This is one of the few times we've ever seen the indicator score above 60% for 6 straight days. The risk level continues to be high because of that, and the fact that the S&P has not yet broken to a new 52-week high." So that's what's happening here in terms of the S&P 500 and its sentiment. We also see in terms of charts, what's called a V-top or V-type bottom, which is a historically rare pattern. But yet we look at recent history, and time and again, when we've seen this type of V-type bottom over the past year. Buyers have stepped in after a modest decline. They've been buying on the dips, and they've been rewarded. So will this time be different? What do you think? 877-711-5611 is the number. Well, like I said before, we've had 9 out of the past 10 years S&P 500 in positive performance territory. We are overdue for a negative year. We haven't had a negative year in terms of performance really since 2008. And it's been off to the races since then. The Fed has certainly fueled to some extent, well, not to some extent, to a large extent, the rally in all asset prices, particularly stocks. And speaking of another asset class, housing. The median home price the median price of existing homes rose just over 10% during the fourth quarter to $196,900 from a year earlier. That's according to the National Association of Realtors, which tracks 164 different housing markets, and that's what's going on there. So existing home prices on the rise, and that's kind of what's happening in that area. In terms of REITs, also known as real estate investment trusts, this particular area is off to the races and having a great year. VNQ follows the U.S. REIT marketplace. Now, when we talk about REITs, we're referring to companies that are involved in real estate development. It could be leasing. It could be managing offices or apartments or special types of real estate facilities like, for example, healthcare or industrial properties. So that is all encompassed in ticker symbol VNQ, which is publicly traded companies that are linked to that. And VNQ ahead so far since the beginning of the year, a delicious 7.5%. You're getting a pretty nice yield there too on REITs. The interesting part here, and I think I've told you this before, but really the key here is tame interest rates. This is a good thing for rate-sensitive sectors like real estate, like REITs. So long as interest rates can remain tame, and they have so far in 2014, you will see REITs continue to do well. Same thing goes for utilities, ticker symbol XLU, another interest rate-sensitive sector. XLU now the best performing S&P 500 sector, Shazam, up 6.1% since the beginning of the year and handsomely outperforming the S&P 500's 0.5% decline. So utilities is an outstanding performing sector so far in 2014. We will talk a little bit about them later on, coming up with my program guest Dan Dolan of the Select Sector Spider ETFs. 877-711-5611 is a number. We're here if you'd like to join us to talk about a particular stock, mutual fund, ETF. I am game. Just give us your first name along with your city, and we will get to you. You can also tweet the program live. At Index Show is my Twitter handle. Now, my February ETF Profit Strategy newsletter has come out, and I encourage you to pick up a copy. Go to etfguide.com, and it is jam-packed with money-making strategies and ideas. We're working on the March edition, which should be out later this week. And again, if you want to stay on top of all the latest ETF trends, the sectors, the single country ETFs, the highest yielding ETFs out there, and to put together a portfolio and an investment strategy that makes sense for you, well, that's the purpose. That's why I publish the monthly newsletter. So it's available at etfguide.com. It's called the Profit Strategy Newsletter. Pick up a copy. So let the spending spree begin. Debt ceilings, as we all know, have done little to curb the U.S. government's escalating debt load. Now, welcome to the next cycle, because U.S. politicians just approved a bill that suspends the government's borrowing limit until March 16th of 2015. What do you think about this? So we're not going to see any more last-minute showdowns about a debt ceiling, at least until next year. It also means the government can theoretically spend however much it deems fit. outstanding public debt is currently at $17.2 trillion. Yikes! Looks like we're going to 20 trillion. This is the Index Investing Show. I'm Ron DeLegge. 877-711-5611. I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, welcome back from the break. You're listening to the Index Investing Show. 877-711-5611 is the number. We're here. We're live. Give us your first name along with your city. If you want to talk about a particular stock, ticker symbol, ETF, mutual fund, what have you, investment theme, investment strategy, portfolio strategy, I'm game. Again, just give us your first name along with your city, and we will get to you. Also coming up a little bit later, Dan Dolan will be my program guest. He's with the Select Sector SPDR ETFs. $78 billion under management. And we're going to talk about some of the S&P 500 industry sectors. You know, healthcare, technology, industrials, energy, utilities. We're going to give you a rundown of what's going on in the S&P 500 sector-wise and discuss some dividend income plays along with other sector strategies, so stay tuned for that. Let's go to beautiful, beautiful Boulder, Colorado. We've got James with us. Welcome to the program, James.
Hi, Ron. How are you?
I'm doing great.
I'm a money manager, 26 years, and I like your show. I can tell you're a straight shooter. I've listened to a lot of shows over the years. I don't know if you've read this article in the newest Forbes. It's about Michael Steinhardt. Are you familiar with him?
Yes, I did. Thank you for tweeting that, and I did catch that, and it's a pretty well written article and loaded. Of course, some of our listeners may not know who Michael Steinhardt is. He's a retired hedge fund manager, and actually he put together a brilliant string of years of performance. And what was it, with the late 90s that he retired, or the early 2000s? I don't remember exactly when, but an outstanding performance in terms of hedge funds. And he pretty much, as far as I can tell, retired on top.
Yeah, he's an interesting character. I mean, I would read articles in Barron's in the early 90s, you know, when you're kind of an aspiring money manager and you read about all these hedge fund people like Soros and Steinhardt, and then you look at their picks when they interview them and all this, they kind of put on these crazy trades. But then there's also this Jonathan Steinberg character who's kind of interesting because he kind of came up through the go-go 90s there with the penny stock newsletter, and he was on TV, you know, on the Financial News Network and stuff. And now here, this article covers a lot of different things here, and it's interesting because, they get this Jeremy Siegel involved, who's a professor at Wharton, and they have Michael Steinberg putting his name on the Wisdom Tree company, and then the article goes to say, oh, he's traded in and out of the stock, and subsequently the stock, you look at the stock chart, WETF is the symbol of Wisdom Tree, and the stock has gone up, tremendously, and it's just an interesting dynamic of what the article is trying to say. Does Michael Steinhardt make a lot of money on the stock, or is the Wisdom Tree thing under, all the money managed in the Wisdom Tree company with all the funds managed by him or other managers, which I think it's just other managers. And I go do some analysis on Morningstar, and I type in some of the, longest running funds in the company, and it looks to me, and I think I included this link on your tweet, that the longest running funds starting in inception in 2006 have not outperformed the S&P 500. So here's like these genius names and Jeremy Siegel and value, and the funds didn't seem to even outperform the S&P 500.
Well, and isn't it funny, because you don't need to outperform the S&P 500 to succeed on Wall Street. Look at the performance of Wisdom Tree stock itself. Ticker symbol WETF. That's the ticker symbol for the stock itself. Up 189% in 2013, and pretty tremendous return. And that's the thing about a lot of their actually most of their indexes, in fact, all of their indexes, really were assembled in terms of, taking a look at the performance in a back-tested world. How did they perform? Had they existed? They put these things in a financial laboratory and they looked at them in terms of performance, and then they assembled them. And of course, it was a brilliant move to get Jeremy Siegel involved. I mean, he's still a very, very respected name on Wall Street and of course in academia. But in terms of performance, what are we talking about here? I mean, this is a brilliant. I don't know if we should call it an insight, James, but it's a brilliant observation that these fancy indexes can't even outperform a market cap weighted index like the S&P 500. I take a look at one of the ticker symbols, by the way, that you gave me, EES. Was that one of the ones that's a small cap earnings ETF? Do you own this particular one?
Yeah, which is like one of the only small cap funds they have, I guess. I looked for with something without. Keep going.
Yeah, is this one that you own or you're looking at?
Oh no. I do a lot of study with the DFS value and the Vanguard value, and I use a lot of comparisons when I'm actually making my decisions. And what I've actually found is the QQQ is like the best one you can buy, and it's got such super low fees. And it looks like WisdomTree has some pretty good app management ratio fees too.
Well, and EES is a small cap earnings. They're overweighting, I guess, companies within the small cap area that have earnings momentum. But it's interesting if you compare that performance of EES versus the just traditional market cap weighted Russell Small Cap 2000, ticker symbol IWM. That's the iShares ETF. Over the past 2 years, performance has been strikingly the same, similar.
Yeah.
I mean, both funds are up about 37%.
Yeah, and they build it up to make you seem like, oh, these guys are geniuses. And even here, like a quote from the article says, since WisdomTree's inception, 85% of the assets have outperformed their peers, as tracked by Morningstar. But that's a little misleading, since a full 49% of its assets are concentrated in just two funds, Japan.
Agreed.
and it's funny, like all of a sudden they're changing the story a little around, and it's just kind of a fascinating article. What are they trying to tell us? Is their company really good? Should we be investing? And then when I do the performance analysis, obviously I'm not impressed.
Well, we appreciate the observations and the call, James. Keep up the good work, and do check back with us.
Yeah, thank you.
Again, that was James in Boulder, Colorado. You're listening to the Index Investing Show. 877-711-5611 is the number. If you'd like to get in and call us, we appreciate that. Give us a ticker symbol. If you don't want to call, you can also email the show, ron@indexshow.com. Now, we talked a little bit earlier about the debt limit for the U.S. government has been suspended until March of 2015. So what will that mean for exploding public debt? We're already at $17.2 trillion, according to the U.S. Treasury's latest statement. Now, the Treasury market has shrugged off concerns about mounting debt and the risk of a future credit event. 10-year yield on Treasuries has calmly declined almost 9% since the start of the year. Yields are now hovering around 2.75%. Same thing for the 30-year U.S. Treasury, which has moved lower, around 6% lower, towards 3.7%. And we see Treasury ETFs that leverage daily performance to government bonds with durations longer than 20 years, like the Direction Daily 20-plus year Treasury Bull 3X shares. TMF, that's been a great trade. TMF has been up 13% since the beginning of the year. So Treasury Bulls have been celebrating since the beginning of the year. Of course, late last year they weren't celebrating. But the other thing here, too, is we've got emerging markets like China, Brazil, and Turkey in a tailspin. Toss in Venezuela. And there's a lot of concern that these countries, capital is obviously outflowing, and risk dynamics have changed with, of course, the Federal Reserve saying it's going to scale back on QE. And so we see, I think, U.S. Treasuries, to some extent, being a temporary beneficiary of these money flows out of emerging markets into so-called safe haven U.S. Treasuries. And that, in the short term, has been the story there. This is the Index Investing Show. I'm Ron DeLegge. We're going to talk a little bit later more about China and some of the emerging and developing issues there. Coming up next, Sector Spider ETFs. Go nowhere.
The Index Investing Show with Ron DeLegge.
Meet Joe Investor. He wants badly to succeed at investing, but he's always on the wrong side of the market. For example, last year, Joe Investor was long commodity ETFs when he should have been short. And the year before that, he was parked in cash when he should have been invested in long-term U.S. Treasuries. And what about this year? Well, like all the times before, Joe Investor is on the wrong side of the market once again. What about you? Are you just like Joe Investor? The Profit Strategy newsletter at ETFguide.com will help you to succeed by keeping you on the right side of the market. We tell you what to buy, what to sell, and when to do it. Join today and get a $50 bonus by using promo code JOE50. Our no bull approach to investing is world famous. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to ETFguide.com to get started. And one more thing, promise yourself to never ever be on the wrong side of the market.
The Select Sector Spiders are 9 ETFs that divide the S&P 500 according to their industry sector. There's healthcare, there's technology, there's financials and industrials, just to name a few. We're pleased to have with us Dan Dolan. He's the Director of Wealth Management Strategies at the Sector Spider ETFs. Dan, welcome to the program. Great to have you with us.
Thank you, Ron.
So let's talk about interest rates, which have backed off. We've got the 10-year Treasury yield now trading around 2.7% compared to 3% not that long ago. And lower rates have been good for the utility sector. XLU is the ETF that follows the utility stocks within the S&P 500. And dividend-oriented investors right now are being rewarded. Talk about that.
Well, I think when rates get at these levels and have stayed at these levels for such a long period of time, investors are looking for income alternatives. And that search for yield is very difficult in this environment. The sector that offers the highest dividend yield is the utility sector. Historically, it has and continues to offer the highest yields in the equity markets. Right now, right around 4% or so as a sector, with some growth potential within those dividends. So what we're seeing here in 2014, as the market is a bit unsteady one week and strong the next week, is that the utility sector is actually the best performing sector year to date, up over 5%. So if you take a look at last year, the sector's up 13%. It's a pretty nice alternative for investors seeking income. That dividend flow was strong, and the very nice part about it is that dividends get increased over time, or at least that's what we've seen over time.
And sometimes the best offense is a good defense, and the utilities, ticker symbol XLU, again, doing quite well. Now let's switch gears and talk about the healthcare sector, ticker symbol XLV, which gained 41% in 2013, and its relative outperformance versus the S&P 500 still holding up so far this year. So what are some of the trends driving the healthcare sector, and what are some of the stocks within XLV?
Yeah, you're starting with the two best performing sectors so far in 2014. Utilities number one, healthcare number two. Healthcare up almost another 5% this year. I think when you look at healthcare, it really combines the defensive characteristics of some sectors and the growth characteristics of others. So when you talk defensive, people will continue to spend money on healthcare regardless of economic activity. It's a priority for them. And when you look at the growth side, you look at the healthcare sector, you look at the pharmaceutical companies, you look at the biotech companies, and there's some very growth, some strong growth companies within that sector. So when you're looking at, the pharmaceuticals, you're talking about the big guys like Johnson & Johnson and Bristol Myers and Merck, and biotech companies like Amgen and Biogen and things like that. And then healthcare providers like United Healthcare and WellPoint, all quality companies. And again, the nice feature here, combining defensive with growth, kind of wraps up into that healthcare sector, and the demographics that we're seeing in the country, you would think that that trend will continue for a very long time.
If you're just joining us, we're pleased to be talking with Dan Dolan of the Select Sector Spider ETFs. SectorSPDR.com is the website. Go there. They've got $78 billion of assets divided across the 9 ETFs within the Sector Spider family. Now, let's talk about the ability that investors have to customize their investment portfolios, their exposure to the S&P 500. Now, we've talked about this before, but just give us an example of how the Sector Spider ETFs could be used for this exact purpose, customized exposure to the S&P.
Well, what we do with the Sector Spider is simply divide the S&P 500 into pieces. So if you own the 9 Sector Spiders, you own the S&P 500. But what's unique about this is that you can weight those sectors any way you like. So if you're a defensive-oriented investor seeking income, maybe you overweight a sector like utilities that we talked about earlier, or something even like financials that has a decent yield. Staples has traditionally a pretty high yield relative to the market. So depending on what your objective is, you can weight the sectors to meet that objective. If you're looking for more growth, you may want to focus on technology and industrials and things like that, and underweight utilities or something along those lines. So the beauty here is that the 9 add up to the S&P 500. Most people can buy an index fund, an S&P 500 fund, in all sorts of ways. This is really the only way that you can buy the pieces, weight them the way you like it, and really customize your portfolio to meet your own investment objective.
Now, people are always looking for a way to hedge against the threat of inflation. And you take a look at an industry sector like basic materials, ticker symbol XLB, which contains a lot of companies that are a good way to hedge against potential increases, price increases in commodities.
Yeah, it's a good point. I think people are always looking for alternatives to throw in their portfolio as a hedge for inflation, where something very simple like this, where you can buy an Alcoa, you can buy a Dow Chemical, Air Products, things like that, that really are quite a good hedge against inflation. That if the economy is improving, these companies take off early, their profits rise, and the underlying basic ingredients that are used to build all sorts of stuff, the industrial production throughout the country, these companies benefit from that. So you don't have to get too fancy here. You can get a small piece. It's only about 3% of the S&P 500. So if you overweight that a little bit, you can very easily have some nice exposure to commodity components within the S&P 500 in an equity participation way, which is probably a little bit less volatile than pure commodities.
Yeah, that's a great point. Again, that ticker symbol XLB, that tracks the basic material stocks within the S&P 500. If you're just joining us, we're pleased to be talking with Dan Dolan of the Select Sector Spider ETFs. SectorSpider.com is the website. Go there. Now, we've seen a proliferation of ETF products over the past several years. Many of these funds don't survive. It's all about buyer beware. But what are some of the attributes, Dan, of an ETF that you believe investors should absolutely demand?
Ron, I think you and I agree on this. I mean, I'm old school when it comes down to the ETF business. Sector Spiders were introduced in 1998, and they were somewhere around the 21st to the 29th ETF in the marketplace. Today there's 1,500, and they're covering all sorts of shapes and sizes of the market. And I think, the product guys are trying to get a little bit more creative every time they introduce a new product because so many other pieces have been covered already. I think what you really need in an ETF is you get back to basics. You get back to, it's an index. It's an index. It's totally transparent. There's very low turnover, so it's, tax efficient, and it's low cost. Again, if you get back to where this started, stuff like Sector Spiders, that's what we did. We had low cost index products, low turnover, totally transparent, and they trade. So when you look at some of these products that you're talking about that are introduced, and they have very low assets, and they trade by appointment, the liquidity is not there. So you want these things to trade. You want the institutional investors to be part of it, the retail investors to be part of it, and those are your best products on the marketplace. You got to avoid those. There's hundreds of the ETFs out there that are recently introduced, not gaining any traction, don't trade much. They have some funky, methodology behind it. Stick to the simple stuff. Stick to what's worked that made ETFs so good and strong for investors.
We talk also about low expense ratios. The Select Sector Spider ETFs just reduced annual expenses to 16 basis points or 0.16%. So give us some perspective. How does that compare with what other ETF families are charging for their sector funds?
We're on the very low end of that. I mean, if you look at First Trust as an example, they charge about 70 basis points. The iShares sector products are up around 48 basis points. We're at 16. When we launched in 1998, our expense ratio was 65 basis points. And we have tried to drive down the expense ratio as our assets have grown and really give something back to investors. We took 2 basis points out with the new prospectus dated January 31st. 2 basis points doesn't sound like much, but on $75 billion, that's $15 million of expenses that we eliminated, which basically the investors benefit from that. So you get higher returns because $15 million in expenses came out of it. Vanguard is slightly lower than us at 14 basis points. The one thing I would take into consideration is it's not only about the expense ratio. You have to buy and sell ETFs. So take a look with you have very tight spreads between bid and offer. Our stuff trades across the board. The 9 trade penny-wide spreads. You can't get any tighter than that. So it's a total value proposition that Sector Spiders offers to investors.
Great points and great interview. Dan, thanks so much for joining us. We hope to catch up with you soon.
Thanks very much, Ron.
Again, you just heard from Dan Dolan of the Select Sector Spider ETFs. SectorSPDR.com is the website. This is the Index Investing Show. I'm Ron DeLegge. Stay with us. I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, we're coming off a great interview there with Dan Dolan of the Select Sector Spider ETFs. We talked about healthcare XLV, which is up 5%. We talked about the utility sector, XLU, great dividend play. For those of you looking for more income, XLU now ahead by just over 6%. And these are some of the sectors, again, that you can use, some of the ETFs that you can use to customize your portfolio's exposure to the S&P 500. So you don't need to own all 9 sectors if you want. You can customize the exposure. In other words, you can eliminate certain ones and add just the ones that you want. For example, if you just want to own technology and financials, XLK and XLF, you can do that. If you want to exclude, let's say, energy and materials, you can do that. If you want to overweight a certain sector and underweight another, you can do that. So these are some of the things that you can do to tweak your portfolio, to customize it to match your investment goals and your personality. 877-711-5611 is the number. This is the Index Investing Show, a live program. Our Twitter handle @Index Show. You can follow me there. You can also follow me at etfguy.com. I publish a monthly newsletter. I also write daily articles. And we are very active also on YouTube. I publish weekly videos, so you can check some of those out. Now, I want to get to an email from Chester, who shot me an email. I'm not sure what city he's listening from, but he asks about healthcare sector. Do I know of any particular ETFs that aim for leverage to the healthcare sector? Now, when we use the word leverage, we're talking about magnification of the exposure to that particular market. So in this case, what Chester is asking is he wants to own healthcare stocks, but with the ability to magnify the results or the returns. And actually, we talked about XLV, which is up 5%. That is the straight healthcare sector ETF, but ticker symbol CURE, that's the one that you should put on your list, Chester. CURE is the Direction Shares Healthcare Bear 3X shares, which aims for triple daily performance to healthcare stocks. So let me give you an example. If the healthcare sector within the S&P 500 or healthcare stocks are up, let's say 1% on a particular day, ticker symbol CURE aims for triple that performance. So 1% is the regular performance, non-leveraged. CURE would aim for triple that, which would be a 3% return. So far this year, this has been a good sector to be leveraging, and ticker symbol CURE ahead since the beginning of the year, 16%. So that's been a pretty good trade. Now, I want to talk real quickly about China and the problems emerging and developing there. I don't believe for 1 minute that China's on the verge of economic utopia, as some of these perma-bull emerging market analysts will say. Now, first of all, take a look at non-performing loans made by Chinese banks, which soared to almost $100 billion in the final 3 months of last year. That's a problem. In fact, that is such a problem that those levels, almost $100 billion in non-performing loans held at Chinese banks, matches levels not seen since September of 2008. What happened during that time frame? Does anybody remember, or have we forgotten? Yeah, that's when the global credit crisis was sparked by the demise of Lehman Brothers. So that's where China is today. Is this time different? Project Syndicate, Ian Bremmer and David Gordon of Eurasia Group wrote, quote, "In short, China's on the brink of large, necessary, and dangerous transformations that promise to change the country for the better or make everything, including regional stability, much worse." End of quote. Unfortunately, people, China's official data on non-performing loans, bad as it may seem, is still a totally unreliable gauge, because no one, not even Chinese officials, have a firm handle on the true scale of busted real estate loans and bad assets held at Chinese banks. Even auditors who are taking rough surveys on the potential damage don't have a complete grasp of deteriorating credit quality happening at China's banks because of the opaque but widely practiced art of balance sheet churning. This is what they do. They hide assets. Moody's estimates that more than half of Chinese corporate and project infrastructure debt is rated speculative grade thanks to a surge in risky lending and aggressive borrowing. Now, this is hardly a bullish backdrop. How do we make money? Well, we make money by being on the right side of the market. And I've been telling you there's only two places to be when it comes to Chinese stocks for the prudent investor. Number one, aggressively short Chinese equities, or number two, aggressively avoid them. Now, all these people that are saying, well, Chinese stocks are cheap, get in. Well, be patient, sir. Be patient, ma'am. Wait for lower prices before plowing in for the long run, because lower prices are probably ahead. At least that's what the market's telling us. And our latest timestamp trade at etfguide.com, we recommended, we advised, we did a buy alert on ticker symbol FXP on December 6, 2013, and we just sold the final leg of that trade on February 10th at $75.50 a share. Our blended 2-month gain for that trade was 23.5%. Not bad for 2 months. And yes, we will see more opportunities, I think, on the short side in Chinese stocks. Also see ticker symbol YANG for those of you that are really bearish. That one aims for triple daily inverse performance to Chinese stocks. FXP aims for double. Another timestamp trade that we just exited was another 2-month trade. We entered in late December, and we went long gold. Just as all of the bears were telling you to short gold, well, we went long gold. Ticker symbol GLD, we bought some call options at around $640 a contract. Those are the March 2014, 112 is the strike price. Well, we just cashed those in for a 2-month blended gain of 65%. A great trade. And gold, by the way, ticker symbol GLD, is doing quite well so far this year, ahead by 9.5%. Silver also doing well, ahead by just over 10%. Gold miners, ticker symbol GDX, up 24%. We're still long gold miners. We went long gold miners on December 26th, and right now we have a 100% position in GDX in the ETF Profit Strategy newsletter at etfguide.com. So there you have it. There's a quick recap of what's happening in some of those markets. If you were not able to get in today and you've got a particular ticker symbol or ETF or ticker symbol mutual fund, what have you, and you want to give it to me and have me give you my view on it, well, you can get in touch with me on my Twitter handle, @IndexShow. Ron@IndexShow.com is the email address. That works. Coming up next week, we're going to be talking more about inverse performing ETFs that are designed to increase in value when certain markets go down. Isn't that interesting? So in other words, we're talking about the ability to short without actually going full hog short a particular stock or a particular sector. Well, these are ETFs that are designed to do that for you. So they, by design, go up in value when certain equity markets or bond markets or commodities go down. So coming up next week, we'll have Direction Shares with us, and you will not want to miss that. Also, my March ETF Profit Strategy newsletter is coming out later this week, and I encourage all of our listeners to pick up a copy. One of the top highlights of the March edition will be my mega investment theme alert. I highlight 10 mega investment themes that are unfolding right before our eyes and how to capitalize on them. So that's available again at etfguide.com. Well, that does it for another episode of the Index Investing Show. Thank you so much for joining us. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.